Yeah, absolutely. Kelvin, taking you back to your comment a moment ago that the Fed may have to ditch its desire to get inflation down to 2%, at least in the current environment. Do you think that at the next meeting there might be some acceptance commentary around the fact that maybe they'd be okay with inflation at a 3 handle?
Yeah, I think they probably won't formally abandon the target, but what they are likely to do is basically couch it in the fact that, in 2019, the Federal Reserve actually formally moved into this flexible average inflation targeting regime. So I think they are probably likely to actually refer back to that strategy back in 2019. And therefore, they don't really have to formally abandon it. But I think starting from next month, they might actually start talking about, perhaps, we might have to live with a higher inflation target, etc., and probably prepare the market for that. Communication has always been the Federal Reserve's way of managing market expectations and managing the market itself. So I think they're probably likely to do that for quite some time.
Our previous guest didn't agree with the market pricing of 3 to 4 interest rate cuts on the back half of this year. And she believed, therefore, that as the market was going to eventually come round to that way of thinking, it would naturally create some volatility and disappointment. Where do you sit vis-a-vis that market pricing? And do you agree that we're also in for a bumpy ride if indeed you're favouring defensive equities and high-quality bonds?
Absolutely. I think the market's pricing of 1 percentage cut for the second half of this year is not realistic and is not pragmatic. The problem that we have right now is that we have this disintermediation process going on in the markets where, a lot of the deposits are still moving into the money market funds. And for the reason that, your money market funds are yielding about 4.3% right now, and your fixed deposits, even on a one-year basis, is yielding less than 1%. So if that keeps moving on, then the stress in the banking sector, I would argue, is actually not over. So if the Fed continues to hike for the rest of the year, it might present some problems from this disintermediation process that is actually going on at this point in time. So I think the likely scenario is that the Federal Reserve, sort of like tries to change the narrative somewhat and say that we need to prepare, we need to live with a high inflation target for at least the time being. At the same time, they'll probably have to hike, but not that much more. They'll probably have to strike a balance between both, which is not easy in the current situation, actually.